Hi, this is Michael Jones, Chairman and CEO of Caravel Concepts. Welcome to Market Insights, our weekly commentary on economic events and their potential impact on financial markets. Let's get started. No, I was completely...
Both. There we go. Now I'm going to actually... Here, can you actually hold it like this?
Okay.
Like with... And make sure that you grab, yeah, exactly, the clips. Because I'm going to take this.
Louise, this is great.
I
It's
know.
hot.
I know.
Hell.
This is why I'm going to take this. You have discovered the reason for our jury rigging. Very astute of you, young Sarah. All right, nope. I'm gonna need you to hold it still just a little bit longer because the tape decided to break on me, and now I have to research for where it went.
Good Lord.
1 second.
Oh,
This
for
will
God's
only
sake.
take- This will only take another 5 minutes.
This week's Market Insights covers what may have been an economic statistic that a lot of people missed, but that could have huge implications for your personal finances and for financial markets over the next several years. We have been pretty consistent in calling for a bubble in home prices ever since the Federal Reserve started printing money to accommodate the federal deficit back in September of 2019. We felt that a bubble was possible when the Federal Reserve was printing $1 trillion and the economy was strong. We felt it became even more possible when the Federal Reserve accelerated to $2.5–3 trillion, even though the economy was weak. So far, that call has proven to be pretty prescient because home prices have been on an absolute tear for the last 3 months, even though unemployment is at double-digit levels. Why are home prices rising so fast? Well, one of the biggest reasons is mortgage rates are at historic lows, and that makes homes more affordable for people. We also have an underlying demographic reason. Millennials are reaching that age where they're ready to settle down, buy a home, move to the suburbs just like their parents. Why? For the same reason their parents moved to the suburbs: better schools and a yard for the kids. So we've got an economic, interest rate driven reason for home prices to go up. We have a demographic reason. Those are all the fundamental underpinnings. And then we have the Federal Reserve pouring trillions of dollars into financial markets. The world is awash with liquidity. That keeps pushing home prices higher. But they reached a really important tipping point this week. It was announced that home prices have now risen to the point where, based on what's called a Housing Affordability Index, which compares the average income for Americans, the average home price, the mortgage rates. It calculates how much your monthly payment is relative to your income. And home prices have risen so much in the last few months that the housing affordability has fully been offset. The drop in interest rates has fully been offset by higher home prices. From here on out, if home prices keep going up, and we expect that they will, that means that you're going to have to make sacrifices in order to afford that home. So the long-term economic consequences are, if the home price bubble doesn't slow down, if we keep rising at the rate that we have for the last few months, then consumers will be increasingly stretched in order to afford that home. What did consumers do, and what did mortgage companies do back in the middle 2000s as home prices rose faster than incomes? Well, they started getting cute with the types of mortgages that they introduced. They started offering interest-only mortgages, flex-pay mortgages, mortgages that essentially allowed people to buy homes that they could no longer really afford. And the consequence of that was when home prices stopped going up in 2007 and 2008, it was not just a calm, slow rusting of home prices, 10 years of not seeing your home price go up the way that most housing recessions have been for the last 80 years. No. When you fuel a home bubble with interest only and flex pay mortgages and people can't really afford that home, the minute prices stop going up, there is a real risk of a catastrophic collapse in the bubble. And that's, of course, what we experienced in 2008, 2009, and it took years for the economy to recover. So, are we at that situation now? Absolutely not. So far, all of the home price appreciation has been supported by the good stuff. More people, millennials wanting to buy homes, and lower interest rates making those homes affordable. But we crossed the threshold this week that says from here on out, continued home price appreciation is going to be more and more dangerous. We need to be more and more attuned to see, are people starting to buy those homes with these gimmicky mortgages from the 2000s? When you start seeing that happen, and particularly when you start seeing the percentage of mortgage closures get to the 20-25% level that we saw for subprime mortgages, interest only, flex pay back in the middle 2000s, that's when you know the housing boom is coming to an end. We are in inning 2 or 3, but we now know what will bring the game to an end. And we can keep an eye on it, and we'll certainly let you know. Thanks for tuning in to Market Insights. We hope you found it informative. If you'd like to see more of our research, you can check it out on our website, caravelconcepts.com, or you can subscribe to the YouTube channel below. Thanks.